Hey, investors, are you feeling the heat of this bear market? Listen, I get it. Red ink everywhere you look can be downright terrifying, but let me tell you something. This market, this right here, this is your chance to make a killing. That's right, this so-called bear market is teeming with opportunities for those brave enough to seize them. I'm talking about stocks priced so low they're practically begging you to buy them. But you gotta be smart, you gotta be strategic, and you gotta be ready to pounce. Over the next few minutes, I'm gonna walk you through my playbook, my battle-tested strategies for not just surviving but in a bear market. We're talking about identifying those rock-solid companies that'll weather any storm. We're talking about dollar-cost averaging, diversification, and yes, even diving into the world of inverse ETFs and hedging. This isn't for the faint of heart, folks. This is for those of you who are ready to stare down fear, buy when others are selling, and come out on top when the dust settles. So buckle up, because things are about to get bullish. Investing in a downtrending or bear market can be challenging, but it also offers unique opportunities. Here are some strategies for navigating and potentially profiting in a down market. Listen up. When the market's in the tank, you don't want to be caught holding the bag on some fly-by-night operation. You want the blue chips, the companies that have been around the block a few times, the ones with strong balance sheets and a proven track record of profitability. Think of it like this. When the economy takes a hit, people might cut back on vacations or fancy dinners, but they're still buying toothpaste, soap, and electricity. That's why you want to focus on consumer staples, utilities, and healthcare. Those essential businesses that people rely on no matter what's happening in the market. And hey, here's the beautiful thing about a bear market. It gives you a chance to buy these incredible companies at a discount. It's like walking onto a used car lot and finding a Cadillac for the price of a Kia. You better believe you're driving that baby home. So do your homework, folks. Look for companies with strong financials, consistent earnings, and a history of weathering economic storms. These are the stalwarts that will not only survive this downturn, but will come out stronger on the other side. Alright, let's talk about dollar cost averaging, or as I like to call it, buying the dip. Here's the deal. Trying to time the market perfectly is like trying to catch lightning in a bottle. It's practically impossible. Instead of stressing about buying at the absolute bottom, we're going to use a strategy that takes the emotion out of investing. With dollar cost averaging, you invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. So, let's say you want to invest $1,000 in a particular stock. Instead of throwing it all in at once, you could invest $200 every month for 5 months. Now, when the market dips and prices are lower, you're buying more shares. And when the market rallies, you're buying fewer shares. It's like a built-in sale. Remember, folks, slow and steady wins the race. Dollar cost averaging is a disciplined approach that helps you average out your cost over time, reducing your risk and potentially boosting your returns. Now, let's talk about diversification, because in a bear market, you don't want to be caught with all your eggs in one basket. Think of your portfolio like a basketball team. You need a point guard, a center, a power forward. You need a mix of players with different skills to win the game. The same goes for your investments. Don't put all your money in one stock, one sector, or even one asset class. Spread it around. Invest in a mix of stocks, bonds, real estate, maybe even a little gold. By diversifying your portfolio, you're essentially hedging your bets. If one investment takes a hit, the others can help cushion the blow. It's all about managing risk and protecting your hard-earned money. Remember, diversification is your friend, especially in a volatile market. So, spread those investments around and sleep soundly at night knowing you're not putting all your financial eggs in one basket. Chapter 4. Dividend stocks. Get paid while you wait for the market to rebound. Listen, when the market's going south and your portfolio is feeling the pain, there's nothing quite like a steady stream of dividend payments to soothe those nerves. It's like getting a paycheck, even when your stocks are down. Dividend stocks are those beautiful companies that share their profits with their investors, typically on a quarterly basis. These are often established, profitable companies with a history of consistent dividend payments. Think of it like owning a piece of a cash-generating machine. Even if the stock price fluctuates, you're still receiving that regular income stream. It's a beautiful thing. Now, not all dividend stocks are created equal. Look for companies with a track record of increasing their dividends over time. That's a sign of a healthy, growing business. And remember, those dividend payments can be reinvested to buy more shares, compounding your returns over time. Chapter 5. Bonds, the steady eddy of your portfolio. Alright folks, let's talk about bonds. Now I know what you're thinking. Bonds? Jim? That's about as exciting as watching paint dry. And you know what? You're right. But you know what else bonds are? They're the steady eddy of your portfolio, the reliable one that's always there for you, especially when the market's throwing a tantrum. Think of bonds as the yin to your stock market yang. When stocks are zigging, bonds are zagging. They provide stability, balance, and a hedge against those wild market swings. Now there are all sorts of bonds out there, but in a bear market, you want to focus on those high-quality government-backed bonds. Think US Treasuries, those beauties are considered about as safe as you can get. So, while everyone else is panicking and selling their stocks for pennies on the dollar, you can sit back, relax, and let those bond interest payments roll in. Chapter 6. Inverse ETFs and Hedging Profiting from the Downside. Now, we're getting into the more advanced strategies, folks. I'm talking about inverse ETFs and hedging. This is where things get really interesting. Inverse ETFs are like the daredevils of the ETF world. They're designed to move in the opposite direction of a particular index or sector. So, if the market goes down, an inverse ETF goes up. Now these are not for the faint of heart. They're best used for short-term trades and hedging strategies, not long-term investments. Hedging is like buying insurance for your portfolio. It's a way to protect yourself from potential losses. One common hedging strategy is buying put options. Now, options can be complex, but essentially a put option gives you the right, but not the obligation, to sell a stock at a specific price within a certain time frame. So, if the stock price drops, your put option increases in value, offsetting some of your losses. Chapter 7. Undervalued Assets, Finding Diamonds in the Rough. Here's the thing about bear markets. They can create some incredible buying opportunities. It's like a clearance sale for stocks. When everyone else is panicking and selling, that's when you want to be out there looking for those undervalued assets, those diamonds in the rough. Now finding these hidden gems takes some work. You need to do your research, look beyond the headlines, and focus on the fundamentals. Look for companies with strong balance sheets, solid earnings, and a history of profitability. Remember, the market is driven by fear and greed. When fear takes over, investors tend to overreact, selling off stocks indiscriminately. This creates opportunities for savvy investors to scoop up shares of great companies at bargain prices. So don't be afraid to get your hands dirty, dig deep, and find those undervalued assets that everyone else is overlooking. Alright folks, listen up because this is important. In a bear market, the most valuable asset you have is not your stock portfolio, it's your emotional fortitude. You need to stay calm, stay patient, and don't let your emotions make decisions for you. Remember, bear markets are a natural part of the economic cycle. They happen. It's like the tide going out. It's bound to come back in eventually. The worst thing you can do is panic and sell everything at the bottom. That's exactly what the fearmongers want you to do. Instead, take a deep breath, remind yourself of your long-term investment goals, and stick to your plan. Remember, time in the market is more important than timing the market. The market has always recovered from downturns, and this one will be no different. Listen, even the best-laid plans need a little tweaking from time to time, especially when the market throws you a curveball like a bear market. That's why it's crucial to regularly rebalance and reassess your portfolio. Rebalancing is like hitting the reset button on your investments. It's about bringing your portfolio back to its original asset allocation. So if your stocks have taken a hit and your bond allocation has increased, you might sell some bonds and buy more stocks, bringing your portfolio back to its target allocation. Now, rebalancing doesn't mean you have to make drastic changes. It's about making small adjustments to keep your portfolio aligned with your risk tolerance and investment goals. Remember folks, investing is not a set-it-and-forget-it proposition. It's an ongoing process that requires attention, discipline, and a willingness to adapt to changing market conditions. Here's the deal folks. In a bear market, ignorance is not bliss. It's a recipe for disaster. The more you know about the market, the companies you're invested in, and the strategies at your disposal, the better equipped you'll be to navigate the volatility and come out ahead. So what does staying informed look like? It means reading books, financial websites, and yes, even watching shows like this one. It means keeping up with market trends, economic indicators, and company news. And you know what? It doesn't have to be a chore. There are tons of great resources out there that make learning about investing fun and engaging. Remember folks, knowledge is power. The more you learn about investing, the more confident you'll become, and the better decisions you'll make. So embrace the learning process, ask questions, and never stop seeking knowledge. There you have it, investors. My playbook for not just surviving but conquering this bear market. Remember, investing in a down market is all about having the courage to buy when others are fearful, the patience to ride out the volatility, and the wisdom to focus on quality investments. Keep your eyes on the prize, folks. This bear market won't last forever. By following these strategies, you'll be well positioned to not only weather the storm, but to emerge stronger and wealthier on the other side. Now go out there, make those smart investments, and claim your victory in this market. Investing in a down market requires patience, a focus on quality, and a balanced approach. Keep a long-term view, and remember that bear markets often present the best buying opportunities for investors willing to look beyond the downturn.